Hey everybody, it's John King. I appreciate you tuning in, whether you are on the Zoom chat or watching me via Zoom or you're watching me on Facebook Live. I appreciate everybody being here and listening in as I talk about the process of upgrading or downsizing, how to buy a home when you already own one. So if you have questions about anything that I'm covering, please feel free to post it in either the Zoom chat if you're on Zoom with me, or into Facebook chat. If I'm watching it live, I'll catch the Facebook stuff. If I'm not watching it live, then, or if you're not watching it live, then I'll comment later and get back to you. So I want to dive in and provide this information. You might be watching this also on YouTube because this will be saved to my YouTube channel, which is youtube.com/johnLOANking. So let's dive in. I got a lot that I want to cover over the next hour. So here we go. So an overview of what we're going to talk about. Really, it boils down to 3 ways to buy a new primary home when you already own one. The first way is very simply to sell your home first and then buy the next one. The second way is to buy and sell them both at the exact same time. And then the third way is to buy the new one first and then sell your old house later. And I'm going to review the pros and cons of each of these options while we go through this presentation today. So the first thing I want to talk about is the scenario of selling your current home first and buying your next home after that. So the benefits here are it makes you much more attractive to the buyer and seller. Because if you're in a position where you're selling your home and you're not trying to buy something else, the buyer of your home has confidence that you're going to close escrow within the time frame that they're looking for. And if you were a buyer looking to buy a house, you're more likely going to want to buy somebody's home that isn't contingent on them buying something else. So it makes it much more attractive for you when you are in a position where you are selling your home first and then buying something else. It also gives you the least amount of pressure because you don't have to worry about accepting low offers from a buyer that wants to lowball you, and you don't have to settle if there aren't any homes on the market right now that you're looking for. So it definitely gives you the maximum amount of control in the process. Here's the problem. First of all, you have to find a place to rent. So how easy is it going to be to find a place to rent when you have to get a lease potentially for a certain period of time? But if your hope is, I'm going to sell this house right now and I'm going to buy the next one, within 2 or 3 months, it's going to be a little bit harder to find a short-term rental. That's your first challenge if you want to sell your home first and then buy. You got the cost to move twice because you've got to move out of your current home and you've got to then either store your goods, your furnishings, all of that stuff somewhere, or move it into the new place and then move it in your temporary place and then move it into the new place that you're going to live in. So there's a lot of moving that has to happen, and that's a pretty expensive cost. And then you got to worry about what if you can't find a suitable replacement because you sold your home. You're now homeless and you're a renter. And if you can't find a suitable replacement, then you might be stuck being a homeless renter. So even though it's the least amount of pressure and the most attractive option, it definitely has some pretty serious cons to it, including the fact that interest rates could significantly go up. What I'll tell you is right now, we think interest rates for this year are going to stay pretty low. We expect that rates are going to stay around where they're at right now, and they're not going to go up a whole lot until probably the middle of next year. The beginning of next year. So when you think about selling your home first and then buying something else after that, just be aware of the fact that you're now homeless, you're a renter, and you don't know where rates are going to be at the time that you go to buy. I really do think rates are going to stay low this year. And so if we can make that purchase happen this year, I think you're going to be in much better shape. But if you end up going till next year before you make that purchase, you definitely run the risk of interest rates being higher. And if you're financing a mortgage purchase, that significant increase in interest rate can really cost you long term. What I'll tell you that we think is happening with housing prices, 2020 is definitely the question mark year. We're not 100% positive where rates are going, or where housing prices are going to go this year, simply because of all of the unknowns that are going on with, COVID-19 and the shutdown, shelter in place. That's definitely impacted the economy. But there is a huge contingent of buyers that are putting a lot of pressure on the market, and that contingent of buyers are the 30 to 35-year-olds that 10 years ago graduated college and moved back home with mom and dad. And they decided, you know what, I'm not ready to buy a house right now. I don't want to adult. Gosh, no, that's not something we want to do. So we're going to stay home with mom and dad and sit in the basement and play Xbox. If you're in that age range, I apologize. I'm not trying to stereotype you. I'm just talking about your friends, not you. But the bottom line is that those people now are deciding, hey, you know what, maybe it's time to get married. Maybe I want to have a kid. Maybe I don't want to live in mom and dad's basement, and they're going out and buying a home. And we feel that segment of the population is going to make home buying purchases in the next 5 years, and that's going to keep driving home prices up. And so you do have to worry if you sell first and you buy later. If that in fact is what happens, then you're selling at a little bit lower point and you're buying, depending upon how long you wait, you're buying at a little bit higher price point. So most people, if they sell their current home first and then they buy their next home after that, they're typically going to try and do it within a shorter period of time. But again, you have to be concerned about, did you have to sign a long-term lease on the place you're going to be staying in the interim? So the simple reason that I talk about that is to make sure that if you choose this option, you need to make sure that you execute on it pretty quickly, because you don't want to miss out on appreciation. You don't want to miss out on time in the market. Too many people talk about timing the market and making sure that you are purchasing at the right time and sell when it's high and buy when it's low. And it's super hard to do that. I got somebody messaging me telling me they can't get in. Hold on one quick second here. Oh, no, she's in the wrong room. So she's got the wrong link. Can you send her the link? It's the wrong meeting link. That's okay. All right. Sorry about that, guys. I've got somebody telling me that it is the wrong link, and it should be 988. Hold on one second here. Sorry, I want to help this person get in that's having a challenge getting in here. Dun-dun-dun. Technology is not my friend right now. That's okay. I appreciate you all giving me 10 seconds to figure this out. Here we go. Give me one more second, guys. All right, here we go. And okay, one more second, gang. I will be right back on. Hang tight for 10 seconds. All right, I am back with you. I apologize. I messaged out everybody that had signed up on Facebook with the code for this meeting, and I gave them the wrong meeting code. So I had one person that couldn't get in because I had the wrong code for them. So my apologies. Bottom line is that I'm back up and going. So if you missed the first part, very, very sorry about that. This will be on my Facebook page, so you can watch this from the beginning. It's being broadcast live on my Facebook page. You can also watch it on YouTube later on. So, all right, so we've talked about selling first and then buying. I'm going to back up because there were enough people that missed the first part of this that I'll simply say, guys, selling your house first is the best option because it makes you the more attractive to both the buyer and the seller. Because when you are selling your house, you don't have to worry about the buyer of your home saying, oh my gosh, I don't know if I want to buy this home because this person has to go buy something else. And so it makes it super, super straightforward. And then when you go to buy your next house, the seller of that home isn't worried about you having a house to sell. You have the least amount of pressure, and these cons are pretty self-explanatory. But again, if you have questions, feel free to post them on Facebook chat or post them on the Zoom group chats. And hopefully that will help answer any questions you guys have. The second way that you can handle selling your current primary residence and getting a new primary residence is actually the most common way. And it is buying and selling at the same time. And that is simply saying, hey, I'm going to put my house on the market and I'm going to find a buyer for my home. And I'm going to go out and search for a home, and I'm going to find a seller that is willing to sell me their home. The problem is you have to figure out which you're going to do first. In other words, you've got to either find a buyer that's willing to wait for you to find the next house you want to buy, or you've got to find a seller that's selling a house that you want that's willing to wait for you to find the buyer for the house that you have to sell. And either one of those circumstances creates what's called contingencies. So this is, as I said, the most common scenario, and the pro is that you're moving only once. But you now have to worry about finding somebody that is willing to accept that contingency. Put yourself in the eyes of that party. As a matter of fact, you are likely going to be in the eyes of that party, because when you go to buy another house and you're trying to sell your house at the same time, what if that seller is also trying to buy another house? It creates what we call the daisy chain effect, or the domino effect of, you've got this deal contingent upon this deal that's contingent upon this deal. And it creates a challenge for everybody involved. And you have to realize that when you are one of those parties that's listing your home for sale, saying, hey, come buy my house, but when you write your offer, you got to realize I'm not necessarily going to sell to you right away, because I've got to wait for the next house that I'm going to buy to be willing to sell me their house. And how many buyers are going to be willing to pay top dollar for your house and then not know when exactly they're going to be able to own it, or if they're going to be able to own it? Because that contingency typically gives you the ability as the seller to back out if you can't identify a suitable property that you want to buy. Your realtor will help you negotiate those contingency timeframes, but it's a major challenge that a good realtor can navigate for you. And I don't want you to be afraid of this. It is the absolute most common scenario when you're looking to sell a house that you own and buy another house, is to do them both at the exact same time. But you just have to be aware that you have to decide with your realtor strategically, what's the market look like? Are we in a position where we are going to be able to find a seller? Is it a seller's market where maybe, seller's market identified as the sellers have the leverage, that there are more buyers than there are sellers? Or is it a buyer's market where there's less buyers than there are sellers? And strategically, which position do you go after first? And that's really the place that a really good real estate agent comes into play, because even neighborhood by neighborhood, it can make a significant difference on whether you should list your house first and then find a replacement property, or whether you should find the replacement property first and then list your house for sale. Here's one of the other major cons. It's the domino effect. So I've had this happen on many transactions where we end up having one party of the transaction unable to perform on time, and it creates a problem for the rest of us. The simplest and most direct way that it creates a problem for you is when it comes to your rate lock. By the way, guys, as a reminder, if you're watching live on Facebook, feel free to post comments on there. If you are on the Zoom chat or the Zoom live, then feel free to post your comments in Zoom chat, and I'll address your questions as you have any. I want to make sure this is interactive and that I'm answering the questions that you guys have. So again, if you have a rate lock, you've defined a specific time frame that you have to close escrow on the purchase of your new home. And if someone else, either the guy that is next in line, meaning that you're buying their home and they're buying something else, or before you, where the person buying your home is also selling their home to somewhere else, and sometimes that can be 3, 4, 5 transactions deep, where each one of these is contingent upon one another. You have to have a concern, a healthy concern, about your rate lock expiring if there's a delay by one of the other parties. Because when you lock an interest rate, we agree with Wall Street, we're going to deliver your loan and you're going to start paying interest on a certain date. If we go past that date, it doesn't mean you automatically get whatever the new market rates are. It means we owe a penalty to Wall Street. And that penalty can be pretty expensive cost. And that's what you need to be concerned about. If some party in the transaction is unable to perform, it might cause a delay. It could cause the deal to fall apart, not having anything to do with your transaction, but just having to do with the other parties in a contingent sale. So that's one of the biggest challenges to contingent sales, is the fact that the domino effect, one challenge on one transaction can create a domino impact on all of the other transactions. Again, most common scenario, so if you own your primary residence and you want to upgrade to a bigger one, you want to downsize into something smaller, you definitely are likely to use this scenario because you get the proceeds from your current home right away, and the money goes immediately into the new house, and so the money transfers without a problem. But you have to be aware of the fact that you also have to worry about timing of possession. You're going to want to talk to your real estate agent about this, because how are you, if you're supposed to buy the next house and close escrow on it, and that's supposed to happen, let's pretend that the sale of your house is going to happen on a Tuesday, and you're selling your house on a Tuesday. Well, the money from the sale of your house has to get to the escrow for the next house for it to close. And that can sometimes take a day. So now the purchase of your home is going to happen on a Wednesday. But you're supposed to be out of your house on Tuesday because you sold it on Tuesday, but you don't get the keys to your new house until Wednesday when you become the owner. And what that's called is seller in possession. And typically there's a time frame. It's usually a few days that's negotiated in the contract when you're writing the contract, just to make sure that when you're accepting the offer from the buyer who's buying your home, that you have negotiated in there, or that your realtor, more importantly, has negotiated in there, that you get to have possession a few days after closing to make sure you have time to move out. Because you also got to make sure that it's reasonably clean. So you want to make sure that you have that time to make that happen. It's very, very difficult, obviously, to put all your stuff in the moving truck on a Tuesday night and then leave it in the truck overnight, I guess, and move it on Wednesday. That happens, and it can happen, but ideally you want to make sure that you have a seller in possession negotiated into the contract so that you have those extra couple of days to actually make the move. All right, so now I want to go into the third scenario. The third scenario is what I call buy now and sell later. So buy now and sell later, one of the big benefits is you only have to move once, because you actually buy the first home and you get to move your stuff in there and you can sell your current house later. It's really, really good because it gives you time to fix up the new home before you move in. And it also gives you time to clear out your old home after moving. And actually, it's kind of nice because it gives you the ability to market your current home, the home you're moving out of. You can list it, and you don't have to worry about having buyers walking through your home while you're living there. We obviously have the challenge that we're dealing with COVID-19 right now, and the concerns that people have of people coming into their home. That just exacerbates this problem. But even without that being a challenge, the fact is that a lot of people don't want to have, if they had the choice, don't want to have a whole bunch of people walking through their house, have to take the kids and leave and find somewhere to go for a couple hours every time somebody wants to look at the home, have to make sure that it's always clean and presentable all the time. If you've already moved out, you've moved into your new home, you take all your possessions out, you clean it out, maybe you work with your realtor to stage the property, whether that means you're leaving behind some of your current possessions or you're getting a stager in there to stage it, but you can make the house look beautiful. Not to say your house doesn't look beautiful already, but there's a difference between the lived-in beauty and staged beauty. And staged beauty definitely helps with the marketability and potentially the value of the home. And so that's another big benefit of buying now and selling later, is you don't have your possessions in there. So when you sell the home, it's a much easier sale. You don't have to vacate the house when you have offers or potential buyers walking in the door. It also opens up another choice for you. You have a choice of keeping your current house as a rental. So that's something that a lot of people choose. Then they say, hey, John, I really do want to have a rental property, and I think that this might be a great way to do it. So many landlords are what I call the accidental landlord. And that is, hey, I bought a house and I decided to buy another one, and I figured I'd just keep my old house as a rental. Just be aware, talk to your real estate agent about, does this make a good rental property? Because not all primary residences mean that they're a good rental property. You have some insurance liability issues that can come up depending upon the nature of the property, that maybe say, hey, this makes it a great primary residence, but I don't know if I want to be liable for tenants living in this home with certain features of the home. You also have to think about the tax consequences. if you keep your home as a rental property. So I'm not a tax advisor. I don't give tax advice, but I do understand the tax rules. And the tax rules essentially say that if you are selling your primary residence, defined as your having been your primary residence for 2 of the last 5 years, you can have gain increase from what you bought the house for compared to what you're selling it for by up to $250,000 per person or $500,000 for a married couple, and that gain is tax-free. Doesn't matter what you do with the money. You don't have to put it into another home. You can take it and pocket that money, but the current tax law says if you've had it as your primary home for 2 of the last 5 years, your gain is tax-free as long as it is no more than $250,000 for one person or $500,000 for a married couple. That means if you move out of the house and you buy another primary home, your clock starts ticking. You have 3 years to sell that home and pocket your gain tax-free. As soon as that 3 years is over, you now owe capital gains on the proceeds on what you gained between what the house was worth when you bought it and what you sold it for. And there's some calculations in there that they adjust for closing costs and other things. So it's not as simple as that calculation, but I'm oversimplifying it. But that's a great option that a lot of people look at, is keeping your home as a rental. Just make sure that you understand the pros and cons of being a landlord. This time next week, so every Thursday night I do a webinar like this. Next week's webinar is about buying investment properties. So if you're thinking about, hey, I want to keep my current home as an investment property, tune in next Thursday, because I'm going to talk to you about the real pros and cons of having an investment property. It is not all sunshine and rainbows, and I'll give you some of the reasons why you might want to do it, and I'll give you some of the reasons why you don't want to do it. Here's the challenge with buying now and selling later. You have 2 mortgage payments because you own 2 houses at the exact same time. If you buy and sell at the exact same time, that second scenario where you're contingent, then I only need to count the new payment, because even though at the time I'm approving you for the loan, you still own your current house, I know it's going to get paid off right on the same day as we're buying the next house. So I only have to count that one house payment. But if you are trying to buy a new house now and sell your house later, you've got to be able to afford 2 house payments. Typically, we are allowed to count rental income from the house that you are moving out of, but COVID-19 is creating some weird dynamics, and it's a temporary issue that we're not allowing people to count rental income from the house they're moving out of. So right now, you genuinely have to be able to afford to make both of the house payments. There are times when you can say, hey, John, I'm going to rent it out, and you can rent it out for 6 months and then sell it after you've rented out the property. So that's a good option. One of the other negatives of buying now and selling later is, can you qualify? Again, you've got to be able to afford to make 2 payments, but more importantly is, can you qualify based on your need for down payments? Because for most of you, the biggest asset you're going to use to purchase your next home is the money that you have in this home. And that is hugely important to recognize, that you can't tap into the money you have from the sale of your current home until you've sold that home. So for a lot of people, it means we have to get super creative in financing. There used to be something called a bridge loan, and these existed before the 2007 market crash. And bridge loans literally said, hey, we're sure you're going to be able to sell your house, no problem. So we'll loan you the equity in your home, and we'll even cover the monthly payments in the meantime, so you don't have to worry about having to pay for 2 houses. Go ahead and buy that new house and sell your old one later. That type of bridge loan just doesn't exist anymore. It didn't exist a year ago or 2 years ago, and it definitely doesn't exist today, because with the economic challenges that have come with COVID-19, we've had a significant reduction in a lot of these fringe loan programs. So what most of my clients end up doing is they end up taking out a second mortgage on their current home. They take out that second mortgage in order to pull some equity out to put onto the purchase of their next home. It's never going to be the full amount of your equity. So you're now going to owe extra money on your new house compared to what you would owe if you had sold your old house at the same time. I'm going to put some math to this. So if you're selling your home right now for $300,000 and you owe 100, and let's pretend there's no fees, then you're going to get $200,000 out of that house, and you're going to put all of it towards the new house. Again, pretending there's no fees. And your new house you want to buy is a $400,000 home. Well, then that's super simple. If you were buying and selling at the same time, you'd sell your $300,000 home, you'd pay off the $100,000 mortgage, the $200,000 would go into the escrow of the next house, and that $400,000 home, you'd have 200 down and a loan for $200,000. Really super, super simple. The problem is if you buy now, that $300,000 home, you might be able to pull out 100,000 in equity because you owed 100, and maybe you'll be able to borrow a total amount of 200. But remember, 100 is already owed on your current mortgage. So you're going to get to pull out $100,000 in equity out of your $300,000 home. You'll get the other 100 once you sell it, but you can't touch that right now. So now you're buying a $400,000 home, and you're going to put $100,000 down. So instead of having a $200,000 mortgage, you're going to have a $300,000 mortgage on the new house and 2 loans on the old one, a $100,000 mortgage you had plus a $100,000 line of credit. Ladies and gentlemen, that's $500,000 of loans that you're going to have to be able to afford to make payments on. When in the end, if you had bought and sold at the same time, you only have $200,000 worth of debt. So it's a big, big difference. That for a lot of people, they can afford that. That's okay. But if you're not one of those people, then you need to pay attention to this as being a challenge, because you cannot get the money from your current home until you've sold that home. Here's the other challenge. It depends on what type of loan that you have. I have a client right now, as a matter of fact, he's a veteran and he's got a VA loan. He wants to keep his current home as a rental property, but he wants to buy another house and he wants to use his VA loan on that next house. FHA and VA say you can only have one of their loans at a time. So I'm actually refinancing his current home and changing it to a conventional loan so that he can qualify to use his VA on the next house that he's buying. So that's something important to recognize, that depending upon what type of loan you have on your home today, it may actually preclude you from buying now and selling later because you can't use that type of loan a second time. All right. The other thing is what we call intent to occupy. This is a very gray area for my industry, but when I explain it to you, I think it's going to make perfect sense. We are selling you this new home and you're getting a loan on there telling us it's going to be your primary home. But we need to believe that you're really going to move into it, because our worry is sometimes people are buying an investment property and they're just telling us that it's going to be their primary home. Now, I know that's not the case for any of you watching, but it does impact you because now we have to prove your intent to occupy. We have to believe that you're going to occupy that property. I had a client who had a nice home. It was a $500,000 home, 2,200 square foot, beautiful home. And he was a family of 4. So it was a 3-bedroom, 2-bath home, perfect size for a family of 4. He wanted to move further away from his job, move up into the foothills, and he wanted to buy a much smaller home. He wanted to buy around a 1,200 square foot home, and he was looking at a 2-bedroom, 1-bath, 1,200 square foot home. And I had this conversation with him and I said, are you going to occupy that home? And he goes, well, yeah, of course I am. I said, okay, well, here's the bad news. The bad news is that back in 2007, 2006, 2005, we would have taken your word for it, and we did. And in believing those people, they've ruined it for you, because back then people did a lot of lying about loans. And we can't prove whether you're going to occupy it until you actually move in. And that doesn't happen until we've already funded the loan. And by that time, it's too late. Now for him, he said, John, I'm a minimalist. I want to have a small property. I don't want to, we don't believe in having a lot of material goods. And, that's just who I am. And I said, I totally understand. Here's the problem. That's not the stereotypical norm. And we're going to go with the stereotypical norm as an industry because we have to defend our decision 5 years from now when we get audited. And somebody says, what in the world made you think somebody was with a family of 4 was going to move out of this 1,900 square foot 3-bedroom home into a 1,200 square foot 2-bedroom home? Are you crazy, John? Or are you crazy, Mr. Underwriter? And that's what we have to defend ourselves against as a lending industry. Intent to occupy. When you are buying a new home and keeping your old home is a major question that we have to be able to answer. If the home is similar to your current home, we won't believe that you're going to move into it. Because if you own 2 homes that are right near each other in the same neighborhood and they're a similar size, and one's going to be a rental and one's going to be a primary home, well, why in the world would you pick up all your stuff and move it from home A to home B? Now, some people say, well, I do that, John, so I can get the better interest rates. Yeah, but once we close the loan, you don't have to move because we've already given you the money. And at that point in time, it's up to you whether you choose to make the move. And that's what we're afraid of. So intent to occupy is a challenge when it comes to buying first and selling your home later. All right, last thing, and I already kind of covered that, was the tax consequences if you wait more than 3 years, if you keep the home as an investment property. Yay, I have a question. Beautiful. I am so happy that you guys aren't sleeping. All right, what about retired people that have 2 homes for seasonal purposes? That's a fantastic question, Denise. So you can absolutely do that, but it's really called a second home or a vacation home. So with a second home or vacation home, you still have to afford both payments, but the benefit is that we understand you're going to use that for your own benefit, and we actually give you owner-occupied terms. You can put as little as a 10% down payment to buy that property, but here's the key. It's got to make sense that you're using it for seasonal purposes. So typically what that means to us is that you're buying a home that is in a resort or vacation-like destination, and that it's greater than 50 miles from your primary residence. So if you live in Lake Tahoe and you buy a vacation home in Lake Tahoe, well, it meets the first criteria because it's in a resort or vacation-like destination. But you already got a house in Lake Tahoe, so you're not going to vacation in Lake Tahoe. So you've got to meet both criteria. It's got to be more than 50 miles away from your current home. And is it exactly 50 miles? No. It just has to logically make sense. I've had some people who, they own a house in Grass Valley and they want to buy a house up at Squaw Valley. Well, that's not 50 miles away, but logically Grass Valley is not a ski town. You can't ski in and ski out of the lodge. And so owning something that is, up at North Star or Squaw Valley or something like that, when you live in Grass Valley, that's reasonable. It makes sense, but it's got to make sense. It can't be, hey, I'm buying a second home in my own town or a couple of towns over, when really that second home is for a family member or something like that. That isn't a viable use of that option. Hopefully, Denise, that answers your question. Feel free to post more questions or follow up if you need to on that. Otherwise, I'm going to move on. I'm going to talk just in general about some industry stuff, and then I'm going to dive into some specific issues that you need to think about when you're thinking about buying or selling your home. Selling and buying a home. The first thing I'll tell you is getting a mortgage today is absolutely tougher than it's ever been. My industry has been severely impacted by the COVID issues and the economic issues that have happened over the last couple of months. We first and foremost were blamed for the collapse of the global economy back in 2008. This time the collapse is not our fault, but we're definitely paying the price for it. And I'm not saying the economy is collapsing, but we're definitely going through some challenging times economically. And specifically right now, we've got the issues with the economy in flux, we've got severe job losses, and we're continuing to see guidelines change on mortgages. And so it's really, really important that if you're thinking about making a move, talk to me early. There's no such thing as too early. I tell people, if you're thinking of making a move anytime in the next year to year and a half, we should be talking now, because there are things you have to plan for that you're not even realizing. Having that conversation early sometimes means, hey, I can pull the trigger sooner than I thought. Sometimes it means I identified something I didn't even realize was a problem. Thank goodness I looked at it now so that I can make sure that that wasn't going to create a bigger problem for me later. So really, really important to do that. In that same vein, I want to talk real quick about types of loans. So The types of loans typically we're talking about are conventional loans. Conventional loans come from Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are kind of the Coke and Pepsi of the mortgage world. So Fannie Mae and Freddie Mac set the rules. They have the recipe for how we determine your qualifications. And both of those programs together are what we consider conventional loans. Typically, you're looking at needing 5 to 20% down for a conventional loan. Typically, you're looking at having excellent credit, and your income to debt ratio is a little bit more restrictive on conventional loans compared to some of the other options. So conventional, I'll help you decide what recipe is the right one for you, but I just want to kind of give you an indication of what types of loans are out there. FHA, VA, and USDA are other recipes, other programs. FHA stands for the Federal Housing Administration. VA is the Veterans Administration, and USDA is actually, yes, the United States Department of Agriculture. Here's the couple of misconceptions. Many people think FHA is a first-time homebuyer program only, and it's not. You do not have to be a first-time homebuyer. As a matter of fact, you just can't have 2 FHA loans at the same time. But you absolutely can have an FHA loan even if you've owned a home before. So the benefit of FHA is the flexibility in their guidelines. I have a client I talked to today, as a matter of fact, and they want to sell their home and buy another one. And I'm going to be emailing her a copy of this video so that she has this information as well. And we were talking, and because of some things in her credit history, she doesn't qualify for a conventional loan. She'd have to wait another 1.5 years to get a conventional loan. But she's worried about interest rates going up. And I am too. I think interest rates are going to stay super low this year. The question is what's going to happen next year and beyond. Right now, the Federal Reserve is putting huge pressure to keep rates low because of the issues we're dealing with the economy and what is truly a recession that we're in right now, that the Fed's going to keep interest rates low to spur the economy. But she does not want to wait until, I'll get to that in 1 second, Denise. She does not want to wait until the 2-year time, until she's allowed 1.5 years from now to get a conventional loan, because we both agree it's going to cost her a whole lot more if rates go up. So she's going to get an FHA loan now. Here's the key. FHA always requires mortgage insurance, even if you're putting 20% down, because FHA is taking a risk that conventional wouldn't take. VA is the Veterans Administration. So if you're a veteran, you serve the military, my hat's off to you. Thank you for serving our country. We have amazing loan programs to help you to reap the benefits you have for the risks that you took, and we appreciate that. VA is great for low down payments, but if you're a veteran and you're selling a home and you have a sizable amount of equity, it often makes more sense to go conventional, because VA has a funding fee, and VA has additional requirements relative to the condition of the property and having to do a termite inspection. And it's often not cheaper than conventional at the end, as long as you're putting a big enough down payment. With a small down payment, VA is absolutely the way to go. All right, Denise, you said, can you have both VA and FHA at the same time? Yes, technically you can. It's rare that I would advise somebody to do that. You cannot have 2 VA loans at the same time. You can't have 2 FHA loans at the same time. But if you're a veteran and you had a VA loan and you did not want to give up that VA loan on your current home, but you want to buy something else, yes, you can use FHA to buy that next home. Great question. USDA is a program that also is well misunderstood. USDA is designed for rural America. Hey, I finally said rural accurately. Usually I say rural. All right, anyway, so USDA is designed for rural America, and it was designed to help farmers who had a lack of banking access for themselves and for their workers to buy homes. And so the Department of Agriculture came out and said, no problem, we will serve the underserved smaller communities. Your large communities are not going to be covered. So you can Google it, or I can send you a link to the USDA map. There are income restrictions on USDA. You can't earn over a certain dollar amount, and you have to buy outside of your major metropolitan areas. But here's the benefit. You have 0 down payment requirement. Now, if you're owning a home and you're selling it to buy something else, you likely have some money for a down payment. So that isn't necessarily a need. But here's the other thing. Sometimes you don't have a lot of money, or maybe you need to use that money for something else. Maybe you need to sell your current home and pay off a bunch of debts, or you need to do a lot of work on your old house or your new house, and you're better off putting the money over there. So USDA, a lot of people think you have to be a first-time home buyer. You do not have to be a first-time home buyer. You just cannot own other suitable housing. So you cannot buy now and sell later with USDA. If the house you're in now is a suitable home, suitability is in the eyes of USDA. So if you just got married and you're the Brady family, and so here's a story of a lovely, okay, I won't sing. Anyway, if you're the Brady family and you just brought 3 boys of his own and anyway, I don't remember the rest of the song, so I won't embarrass myself anymore. But if you bring a blended family together and you just immediately outgrew the size of the house you were in, especially if you've got Alice, because that just totally blows the numbers for the size of the house. Now you can use USDA to buy your next house, even though you have a house and you're keeping it, because you are okay with USDA because you don't own suitable housing. The other area I want to talk about is jumbo loans. Jumbo loans depend on what market you're buying in across the country and within each county. In the Central Valley, San Joaquin County area, jumbo loans are anything over $510,000 as a loan amount. In the Sacramento market, it's anything over $569,000. In the Bay Area, it's over $760,000 is considered jumbo. Right now, jumbo loans are really, really hard to get because of all the issues that are happening with COVID-19. In general, jumbo loans are a great option. Right now, they're a challenging option. All right, I'm going to move on now and talk about funds to close. Just a quick review or recap, just so you know. When you buy a house, you've got both your down payments and your closing costs. So when you think about, hey, I'm selling my current home, you've got to think first and foremost, there's a cost to selling your current home. The seller pays for both real estate agents on transactions in California. I won't speak to transactions outside of California because all I do is California stuff, but on transactions in California, the seller is typically paying for both real estate agents. So as the seller of your home, you've got the expense of paying for both realtors. Typically, that's somewhere 5 or 6% of your sales price. You might have some repairs that have to get done on your property. You are going to have some title companies fees and some notaries fees. So there are costs that are associated with selling your home. So make sure you're talking to a really good realtor to get an idea of, hey, I'm going to sell my house for this much and I owe this much. How much am I really going to get? Because it's not as simple as subtracting those two numbers. But then when you go to buy the next house, you also have to account for the closing costs on the next house. You can ask the seller to help you pay for the closing costs, but it is not really, it's not a good idea if you can do it on your own, because all you're doing now is making the negotiation even harder. So if you're tight on money, asking for seller credits for closing costs, asking a lender credit, but the lender will only pay closing costs if we charge you a higher interest rate, because nothing in life is free. All right, so I want to now spend a couple minutes going over some other considerations that I want you to pay attention to as you're thinking about buying a new home to replace your current home. The first thing I just covered, budget for closing costs on both transactions. The second thing is think about how much of your proceeds you want to put down on your new house. We figured out the numbers already about, hey, I've got closing costs on the sale of my home, I've got closing costs on my new house, but do you really want to spend all of that money to purchase your new home? Maybe you want to keep some for repairs and upgrades. Maybe that's repairs and upgrades on the new house you're buying. Maybe it's repairs and upgrades on the house that you're moving out of. I will tell you that it is a pet peeve of mine that I think the average homeowner is waiting to do all the work they want to do on their home until they're ready to sell it. And you just wasted all of those years that you could have been enjoying those upgrades, but you end up doing the upgrades right before you sell the house. So if you're thinking about selling your house years down the road and you're thinking about all the work you want to get done, the truth is you're going to do the work before you sell it. Do it now. Do it now so that you can enjoy the home that you're in and not make it perfect right before you move out. That's the same thought when you think about the next house that you're buying. Because when you buy that house and you have all these grand plans, oh my gosh, if I did this with the backyard and I did that with the backyard, and if I did this with that room, and you have all these plans, but you end up getting in life situations and life happens and life prevents you from doing the things that you wanted to do when you wanted to do them. And the best laid plans just don't happen. So set aside some of the money right now. don't put as big of a down payment, and talk to me about the different scenarios about whether you really do want to put all of that money down on the new house, or will it make only a little bit of a difference in your monthly payment to keep back 10 or 20 or $50,000. I'll tell you a simple story. I'm literally in a room right now because of exactly that situation. When we bought this house, we bought this house first, sold our old house after. This was 10 years ago. Gosh, it was 9 years ago. Anyway, and the room that I am in is an office that comes off of my master bedroom. And it is actually what was a 2-story living room. So you walk in the entryway and the living room's on the left, and it was a 2-story room, vaulted ceilings. And we thought, well, that's kind of a waste. I don't know what it cost us to do this, but we set aside the money and we basically cut that vaulted ceiling in half and we put a room here. And so I am floating where when the original builder built this home was just air above the living room. So those are the kind of things that I created an office when I bought this home. I never would have done that later. I never would have interrupted our life to have this kind of construction done inside the home. And that's something you need to think about. Maybe you want to pay off some debts. You definitely don't want to go into a situation where you're buying a new home and you have a significant amount of debt that you're also carrying. So maybe you decrease your amount of down payment and you pay off some debt. Sometimes it's the exact opposite. Maybe you've got money that is sitting around doing nothing and it's not making you any good money. Maybe you put more money than just what you're getting out of the sale of your home to minimize the amount of your mortgage. Maybe you can even get your mortgage balance down low enough that you can put it on a 15-year or a 10-year mortgage and pay it off even faster. I can help you strategize on all those situations, but just don't automatically say, oh, I'm selling the house for this much and I'm getting this much in proceeds. That means that I'm automatically going to put all of that towards the purchase of the new house. That is not the right decision. It may be the right decision in the end, but without giving good consideration, I don't recommend that being the right way to go. Can I have two primary residences? I kind of already covered that earlier, so I don't know that I need to go very deep into that. You cannot have two primary residences. We're always going to look at intent to occupy and figure out which one we think you're going to occupy. All right, I'm going to cover the F word. So for anybody who's watched any of my videos in the past, or if you go to my YouTube channel, you'll see me talk about a lot of things. Forbearance is a major issue for the mortgage industry right now. And forbearance is a short-term remedy that was created back in March when the government shut down the economy. And the government essentially said, hey, we're going to allow homeowners who are impacted by the COVID shutdown to skip their mortgage payments for anywhere from 3 to 12 months. The problem is the government said it's not going to impact your ability to borrow on a mortgage. Excuse me, the government said it's not going to impact your credit. You can file forbearance and it won't impact your credit. That is a true statement. It's not impacting your credit score, but it is impacting your ability to borrow money. As of right now, so I'm recording this on May 14th. The rules have been changing every single day. As a matter of fact, a major rule changed yesterday that I'll tell you about. You're one of the first groups I'm telling this about. But the rules change all the time, especially around forbearance. Right now, the industry is saying you cannot qualify for a new mortgage until after you have caught up your forbearance, started making your payments, and had a year of on-time payment history. So that's a major concern that I've been running into clients regularly over the last couple of weeks that have had a forbearance filed on their home. It shows up on their credit report. It doesn't hurt their credit score, but it shows up on their credit reports and they are unable to qualify for another mortgage, and they were shocked. I said, why didn't the bank tell me this was going to hurt my ability to buy another home? And I said, because they didn't think of it from that perspective. And they're bound from a legal perspective to not discourage you from filing forbearance. And if they told you the negatives of filing forbearance, then they're discouraging you and they're forbidden from doing so. Now, the real quick thing that changed yesterday is Fannie Mae and Freddie Mac came out and said, if you have filed forbearance on a mortgage that's backed by Fannie Mae or Freddie Mac, once the forbearance period is over and you attest to the fact that your income is back up, you don't have to prove it, you attest to the fact that your income is back up and that you can afford the payment, they will automatically defer all of the payments that you skipped to the end of your mortgage. no hit on your credit report, no interest being charged, no penalties for doing so. And it has streamlined the process that I was fearful was going to be a major problem in getting people to catch up their payment after the forbearance. They've simply waved their magic wand and said, okay, if you were on forbearance and you now can afford your payment again, then just tell us you can afford it again, and we take those months you skipped and automatically put it to the end. It is definitely a fix to one of the problems, but the second problem still exists, and that is impacting your ability to borrow money down the road. Maybe they're going to come out in the next couple of weeks and tell us, nope, it's not going to impact somebody's ability to borrow money down the road. I don't know. At this point, they haven't given us clear guidance, so we can only act upon the best rule that is similar. And in the eyes of the mortgage industry, the closest rule is, well, you're supposed to make all your mortgage payments on time, and you can't have missed any mortgage payment in the last 12 months. So right now we're considering a forbearance as being somebody who missed a mortgage payment sometime in the last 12 months, and therefore you have to wait until the end of 12 months of new on-time payments to qualify. That is subject to change because these rules, especially around forbearance and the COVID resolution options that are out there, are changing on a regular basis. A couple other considerations. What if I'm buying a new construction home? That changes everything about the sale of your current home. First of all, the new construction builders do not like contingent sales. They want you to sell your home first and rent, or they want you to buy the new home and sell the other one later. Because a new home is going to take anywhere from 3 to 12 months to build. And so that builder is approving you today and building the home for you starting today, but then they're going to customize it to you. They're going to put the options and upgrades you want in there, but the only way you're able to qualify is if you sell your house, and you're going to wait to sell it until right before the house is finished. And the builder gets really nervous about that because they have huge carrying costs if they don't sell you the home as soon as they're done. Because think about it. A normal seller, you're a seller. If you're selling your home, you own your home right now. If something happens to your transaction and it doesn't close on time, that stinks. But the truth is, you still had to live somewhere. So you're making one mortgage payment. It just didn't get to move where you wanted to move. But you already had to pay for a house payment, and you're just stuck paying the house payment in your old house instead of being in the beautiful new house you were trying to buy. But the builder doesn't live in that house. So when the builder's finished building it, they need to pay back their construction loan so they can have that money to start building the next house. And so the builder does not like, most builders do not like or even allow for a contingent sale that is going to happen at the exact same time as you purchasing the new home, because there's too many chances that they're not going to happen at the exact same time, and they're going to be stuck holding the loan and making payments on their construction loan while you're trying to sell your home. How quickly can I refinance? People are in the scenario where, hey, what if I bought first and then I sell my house, and now I've got that cash from my house and I want to refinance and I want to pay it into the house loan? You can refinance as quickly as you want. Most lenders might tell you, oh my gosh, you have to wait 9 months. Well, here's the truth. The reason they tell you they have to wait 9 months is because we lose our income if you pay off the mortgage within the first 9 months. So somebody without consideration to what is in your best interest, and they're only being selfish, will tell you you cannot refinance in 9 months. The truth is you can refinance anytime you want, but I lose the revenue I earned on that first transaction. So the first thing I tell my clients is, if you're going to do it, please come back to me, because at least if I lose the income on the first transaction, I'll make it back on the second one. So I'm doing 2 transactions and only getting paid once, but it's better than doing 1 transaction and not getting paid at all. So you can refinance as quickly as you need to, depending upon your circumstances. Here's another thing to consider. Should I use the same realtor for both transactions? I've had people ask me that question because, hey, the realtor I'm working with, they're a listing agent. The realtor I'm working with is a buyer's agent. The truth is, guys, there are too many moving parts for you to have multiple people representing you on both sides of the same transaction. So yes, find a realtor you trust and stick with that person. If you don't trust the realtor, then don't use them. But if you trust them, you need to use them for both the sale of your current home and the purchase of your next home, because that person is going to intimately understand what your wants and needs are, and they're also going to be pulling the strings to make sure everything happens in the time frame that it's supposed to happen. Trying to use two different realtors to do that will create a nightmare for you. It will not help your situation. Future of interest rates and rules on when you can lock. So I'm going to wrap this up here pretty quickly. What I'll tell you is, I already mentioned earlier, we think interest rates are going to stay super low for around the next year. We think interest rates are going to start going up next year. Housing prices will be, who knows, a little up, a little down this year, but we think between next year and 2025 or 2026, we're going to continue to see housing prices appreciate. Here's the issue with when you can lock. You can lock when we know that the transaction is going to close within a fixed time frame, whether that's 30 days or 45 days. So if you're trying to buy and sell at the same time and you find one party but not the other, you can't lock until you have both of them, because there isn't a defined close of escrow date, or at least there's too many chances it could fall out of escrow. And so you're not locking your interest rate until you find the seller to sell your home, the seller to sell you a home, and the buyer to buy your home. All right, the last thing I'll tell you about is, or I think it's the last thing, is our Helping Hands program. Some people say, John, I'm selling my house and buying another primary house because the truth is I've got aging parents, and my aging parents, they can't afford a home of their own, and so I'm going to have to sell to buy something bigger to take care of them. If that's your situation, or you know somebody who's in that situation, and you say, I really don't want to have to sell my house to buy something bigger, there is an option. The option is called our Helping Hands program. It allows you to buy a home so I said earlier, can you own two primary residences? And I said the answer is no. I was lying. Here's where you can. It allows you to buy your parents a home. You consider it your owner-occupied property, and your parents are not on the loan. So I own my house right now. And if I wanted to buy a home for my parents, if they could not afford a home on their own, I can do so, and I consider that a primary residence. So I get the same low interest rates as a primary home. So I essentially have two primary homes. One is my primary home, and one is for my parents who cannot afford to have a mortgage of their own. There is another rule that says I can also buy a home, you can also buy a home for an adult disabled child. So if you know somebody in that situation that has an adult disabled child and you want to buy a home on their behalf, you can also consider that to be your own primary home. Just consider the fact that you have to be able to afford your home payment and their home payment, because clearly the rule says you're buying it for a parent who cannot afford the mortgage on their own. Therefore, your income has to be able to afford to pay for both. All right, guys, I really, really appreciate you listening up. I think that Summit Funding is definitely the place to help you out with all of your needs. We really focus on being the key difference in helping you through this transaction. Hopefully you've gotten some good information and insight in this hour that we've spent together. If you have any questions, feel free to post them in the Facebook chat or on the Zoom chat. Other than that, please share this. So all of these videos are on my YouTube page. Go to YouTube and search johnLOANking. So one word, loan's my middle name, just put it all together, johnLOANking on YouTube. I've got some great playlists and videos, and I would really appreciate you guys sharing that with anybody you think could use the information. I hope you have an absolutely amazing evening, and join me next week if you want to find out information about buying investment properties and whether it's the right thing for you. If you know anybody that might want to come to that, send them to rsvpwithjohn.com to register. Thanks, gang. Have an amazing night. Bye-bye.